It started off as just a war of words, but since then, President Trump's dispute with Chinese leaders over trade has steadily escalated. 6 months after we last examined the brewing trade war with China on the show, the question becomes, where does it stand now? And how exactly will it end? Yes, it's time once again to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional style investing to your portfolio. When we last looked at the current administration's growing trade dispute with China, and we did this on our show last April, many questions surrounded it. Would it escalate? Would the economic impacts here undermine the president's tax cuts? How would the financial markets and industries most affected respond? And was a trade war really winnable, as the president once tweeted? Well, much has changed since April, and the answers to some of those questions may be a bit clearer now. We'll break it all down today with the help of our guests, veteran investor Jim Rogers and author Gordon Chang. First, let's revisit how the growing trade war, specifically with China, came about before we discuss where it stands and how it might end. From the start, there's been little argument about the need for addressing the U.S. trade imbalance and the renegotiation of some of the past trade deals that helped create it. A country's trade balance is the difference between the monetary value of its exports and imports. A positive balance is known as a trade surplus, where exports are greater than imports. Contrarily, a negative balance is known as a trade deficit, where the opposite is true. In August, U.S. trade deficit rose by 6.4% to $53.2 billion. It was the third consecutive month of increasing trade deficits for our country and a record high since February, which we'll talk about a bit later. The point is that the motivation behind the president's efforts on trade have never really been disputed. Its efforts themselves and his approach to them, that's what continues to cause controversy. For him, it's all about unbalanced tariff systems in which other countries impose larger tariffs on our products than we do on theirs. Now, a tariff, as many people know, is a kind of tax or duty charge. And if we're paying a 20% tax to export a product, but only charging 2% to import the same product, that's clearly a big financial advantage for the other country. Now, the president's effort to rebalance the tariff system has involved slapping new tariffs on imports from many countries, but his main target has been China. Now, while that may be understandable for a number of reasons, for many economists and analysts, it's also deeply concerning. Even more so as the trade war heats up. It's understandable because China has a long and well-known history of taking advantage of the unlevel playing field in international trade. For example, the country has long been suspected of suppressing the value of its currency to make the price of their exports more attractive to buyers from other countries. China is also notorious for gaining a competitive advantage in trade by paying its workers low wages and investing little to ensure good or even safe working conditions. China is known to practice mercantilism, an economic policy that prioritizes trade advantage and pursues every competitive advantage it can get. Its mercantilistic tactics have been well documented over the years to include those already mentioned, along with worker subsidies, restrictions on foreign investment, and of course, high tariffs. Reducing the trade deficit and renegotiating unfair trade deals, particularly with China, was one of Donald Trump's campaign promises. But it wasn't until earlier this year that he really became focused on this effort. In April, he called for new tariffs on $50 billion worth of Chinese imports, everything from steel and aluminum to batteries, airplane parts, and flat-screen televisions. As expected, China retaliated with new tariffs of its own on 128 products imported from the United States, including a lot of those that are manufactured in states where many of the president's base supporters live and work. In other words, it's been clear from the start that China is just as willing as the president to play hardball in this contest and to aim not just for economic impacts, but for political ones also. Which, of course, comes as no surprise to the many analysts who have expressed concerns about the potential fallout of a trade war with China from the very start. Those concerns have only increased since April as the tit-for-tat tariff exchanges have escalated, and as real economic impacts have been felt in both countries. Many farmers have been hit hard, along with the auto industry, and manufacturing plants in several states have also closed. The U.S. Chamber of Commerce has stated that the president's trade policies could lead to 2.6 million American job losses in total. Now, in spite of these impacts on certain sectors of the economy, yes, it's true that U.S. GDP growth did hit the president's campaign promise of over 4% in the second quarter, a rate of growth his administration claims is sustainable. By comparison, though, China's GDP growth hit 6.7% in the second quarter. While that was a slight drop from the previous quarter, for some economists, this says something about the competitive strength of the Chinese economy and its potential to withstand the effects of an escalating trade war, perhaps even better than our own. Others give the United States the edge in terms of the overall strength. But what about resolve? Well, culturally, historically, and politically, the question becomes which country is better equipped to, quote, win a trade war? We'll talk about that and more about where things currently stand in just a bit. Right now, it's time to welcome our first guest, Jim Rogers. Jim Rogers is an American businessman, investor, traveler, financial commentator, and author based in Singapore. He's chairman of Rogers Holdings and Beeland Interests Incorporated and creator of the Rogers International Commodities Index. His many best-selling books include A Bull in China, Investing Profitably in the World's Greatest Market, and Street Smarts, Adventures on the Road and in the Markets. Jim, welcome back to the show.
I'm delighted, David. The introduction was too long. Let's get to the chase.
Okay, so let's talk about China. You know, we're probably one step away from having tariffs on every single product that comes into this country from China. Is China eventually going to soften, or are they going to stand as tough as President Trump on this issue?
Well, I suspect they're going to stand tough. They don't have to answer to anybody except themselves. So I would suspect that they can last longer than Trump. You know, if we start having economic problems and farmers start getting unhappy because prices are down a lot, you know, China's our largest agricultural customer. So I suspect that China can outlast us, but who knows?
So you actually think I've had a lot of
David,
people on
David,
the show.
David, the main point, David, is this should not be happening. Trade wars are never good for anybody.
Yeah.
Nobody has ever won a trade war. I mean, this is insane what's happening.
So you think this can't be won by anybody, but do you agree that the trade balance has been unfair for a long time in favor of China?
Unfair? Why? I don't know why you say it's unfair. Our costs are very, very high in the United States. You know, we spend something like several times as much on medical care as the rest of the world, and we're not even in the top 25 for life expectancy. We spend the same for education. Our kids are not even in the top 25 on the international test. I mean, our costs are extremely high. We have enormous inefficient litigation. You know how much we spend on litigation? We have more lawyers than the rest of the world because we have so much money spent on litigation. We're a very high cost place to do business. So I wouldn't say that the Chinese are evil, vicious people. We have a lot of problems that we're not addressing.
Okay, and I'm not saying they're evil or vicious people, but in terms of tariffs, the fact that everyone seems to be in consensus for the most part that the tariffs they levy on our products are much worse than the tariffs that we levy on their products. Do you at least agree with that?
I'm sure we can go case by case and you prove your point, and I'm sure that can be corrected. We do need to have a level playing field. There's no question about that. You say it's unfair, and if you can show me things like that, of course I would have to say the same. But David, this has been going on a long time. We have trade deficits with a lot of countries, not just China.
So what approach would you take differently? I know everyone says trade wars are unwinnable, and I certainly cannot argue with that. What would you if you were sitting in the big seat in D.C., How would you have handled it differently? How do you think this should have been handled as opposed to this crazy trade war we're in?
Well, the Asians have said many times, please, let's talk. Let's sort this problem out one way or the other. Let's not get into a big fight. Maybe they don't mean it. I don't know. I do know that Trump has a lot of guys around him who are dying for a trade war. You know, they write books about things like this. Their main intellectual emphasis is trade wars are good. I happen to have a different view, and I think history has a different view. The Asians say we can sort it out.
Okay.
Washington's advisors say no, hit them in the face.
So tell me, I know you have business interests over there in Asia, so tell me in the 30 seconds or so we have left in this segment, what's the general sentiment of the average Chinese consumer right now about America and what's going on?
I don't know the average, but I do know that everybody in Asia knows that Mr. Trump is making China great again. You know, he's doing a lot of things that are building up China and hurting us in the long. We pulled out of TPP on his first day, and the Chinese looked around and said, wow, he's given us Asia. So everybody knows that Mr. Trump is hurting America more than he's hurting Asia in many things. That's in Asia. That's what they see.
Gosh, interesting take, and I've got to tell you, you're probably not making our Newsmax viewers very happy with that comment. But nonetheless, they want to hear more from you, and so do I. So stay with us, please. And you stay with us, too. You're here on The Income Generation, and I'm David Scranton. We'll be right back with more from Jim Rodgers.
Visit the Retirement Income Store at soundincomestrategies.com today to receive your free digital income kit. The digital income kit includes free reports, whiteboard animations, and an educational DVD, all packed with easy-to-understand information on how actively managed income-based investment strategies can help you achieve your retirement goals. Go to soundincomestrategies.com right now and click on the Income Kit tab to request your digital income kit absolutely free.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. That Tom Petty classic is a pretty accurate summary of where the trade dispute with China currently stands. As it continues, both sides are claiming that, yes, they just won't back down. Just last week, China's Minister of Commerce, Zhang Shan, accused Donald Trump of bullying China with his trade policies, and he vowed that his nation would rise up if things escalated further. In total, the Trump administration has now placed tariffs on $250 billion worth of Chinese goods, affecting more than 5,000 products. And the president is on record as saying that he's willing to, quote, go to 500, which would mean placing tariffs on virtually all U.S. imports from China. Although initially considered just more tough talk after the last round of tariffs in September, many now see the president's threat as a genuine possibility. As for China's response, well, again, just think about Tom Petty. Or, as Minister Zhang put it, There is a view in the U.S. that so long as the U.S. keeps increasing tariffs, China will back down. They don't know the history and culture of China. The U.S. should not underestimate China's resolve and will. Now, along with the tariffs, communications between the two countries have become increasingly strained, especially in recent weeks, undermining efforts to bring China to the negotiating table. In September, China canceled planned talks between mid-level officials. And more recently, Secretary of State Mike Pompeo got into his own war of words with Chinese Foreign Minister Wang Yi during a trip to Beijing. Adding to the worries over escalating tariffs and each side's refusal to flinch, new concerns are emerging over the possibility of a currency war. As mentioned earlier, China has long been suspected of suppressing the value of its currency to make the price of its exports appear more attractive. Just recently, Treasury Secretary Steve Mnuchin vowed that preventing competitive devaluations would have to be a part of any trade agreement reached between China and the United States. Many experts, though, are skeptical that China would agree to that condition. But that may become clearer late November, when Trump and Chinese President Xi are reportedly scheduled to meet during the G20 summit in Argentina. In the meantime, though, despite strong economic growth in the second quarter, the U.S. trade deficit continues to increase. According to estimates, it could hit a 10-year high by the end of 2018. This widening gap is said to be mainly due to lower exports on soybeans, crude oil, and other commodities as a result of China's retaliatory tariffs on these products. As we discussed on last week's show, the situation has also led to underperformance in the commodities markets this year. Trade news has negatively influenced commodities prices also, and some investors have suffered because of it. As for the overall stock market, until recently, Wall Street seemed to have settled into a wait-and-see attitude with regard to this trade dispute. That may have changed as of just last week. The markets plunged over 2 dramatic days, with the Dow Jones Industrial Average shedding more than 800 points on October 10th, another 545 points on the 11th. Both the S&P 500 and the NASDAQ suffered similar losses, and analysts agreed the biggest factors behind the sell-off were likely increasing worries over rising interest rates, combined with the potential impacts of escalating trade wars with China. Meanwhile, the president took the opportunity to criticize the Federal Reserve, which he's done in the past, about its proposed schedule for raising short-term interest rates. The Fed approved its last rate hike in September and has said it wants to approve 2 more before the end of the year. The rate hikes are ostensibly a vote of confidence in the economy's strength. But one of the likely unstated reasons behind the Fed's ambitious pace is to ensure that it has some ammunition in the future to lower rates again should the economy slip into another recession. With the trade war continuing to heat up and neither side seemingly willing to back down, the question becomes, what are the odds that it could trigger that next recession and the next major sustained market correction? We'll talk about that in just a bit. Now, let's welcome back Jim Rogers. So, like I said at the end of the last segment, I know you're not making our conservative Newsmax viewers happy with what you said, but then again, you've never been one to care what people think. You just speak the truth, and that's what we love about you. So let's get on.
I just want to clarify. You asked me what the Asians are thinking about this. That's what they're thinking. We may not like what they're thinking, but that's what they're thinking.
Fair enough. Thank you for that. Good clarification. So now let's get on to another topic that we talked about last time you were here, and you probably remember. But we talked about debt, and I was talking about the bubble in the economy and the talk about in China, a lot of the big skyscrapers that are empty. And I said, is there a bubble there? Is there a GDP artificially inflated? And your comment was the biggest bubble we have is the debt bubble going on in the United States. You still feel that way? Is that still one of your bigger concerns overall?
David, if it's not one of yours, it should be. Let me emphasize to you, yes, there are problems in China. China's going to have a lot of problems coming up when people start having problems. But the debt in the United States, I mean, just this week, it was announced that we have staggering more debt. That's just at the Washington, D.C. level. The rest of the country, too. Debt is going through the roof everywhere.
So why do you think President Trump doesn't seem to be concerned about this? A lot of people are in his ear saying, hey, you can spend your way out of a bad economy. You obviously don't necessarily believe that, correct?
Well, if the solution to too much debt is more debt, then yeah, that's a wonderful solution. I've never known that in my life, and I've never known a country that got too deeply in debt to get out of debt and to solve the problem with more debt. But maybe that's the way it's going to work. Maybe that's like saying Mr. Weinstein, whatever his name was, needed more girlfriends to solve his problems.
I love that. Great analogy. So you were published recently, you quoted recently as saying something that the market highs don't necessarily excite you, but it would be new lows that would excite you. Talk to our income generation viewers about that, please.
Well, I'm not a very good market time, and I know I'm a horrible trader, so jumping on a moving train or a moving bus for me has always usually led to problems. I like to buy things that are sitting down cheap, wallowing, being ignored, because usually, even if you're wrong, you're not going to lose too much money. But if you jump on a train that's racing ahead and you're wrong, you may lose a lot of money, and that's been my experience. But there are guys who can do it, David. I'm just not one of them.
Now, clearly you sound confident that the market is going to take a big tumble at some point, and I agree. And I agree with your philosophies also about the possibility of really the debt bubble that we have in our country. I don't think creating more debt is the answer to getting out of debt. So the question I have for you in our last 30 seconds or so is, do you think that it's just all of a sudden the country's going to wake up someday and realize this debt is out of control, and Wall Street will wake up someday and maybe that'll be the trigger that causes the next major market drop here in the United States?
It usually starts someplace we're not paying attention to. In 2007, it was Iceland. Eventually, it snowballed, and it was Lehman Brothers. And then we all knew, oh, gosh, there's a problem. That's the way it nearly always works with bear markets. So start looking around at places that you're not paying attention to.
It's the gotcha that you weren't counting on. Good point. I say that all the time. Jim, stay with us for one more segment, please. We want to have you back here, more questions. And you stay with us also. I'm David Scranton, and you're watching The Income Generation. We'll be right back.
David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model. Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 core values to help protect your money in good times and bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
When we were kids and even younger adults, there was no such thing as binge watching. If you wanted to find out what happened in the next episode of your favorite show, you simply had to wait. You couldn't sit there on the couch and follow the entire series to its conclusion in one night. Unfortunately, the battle with China over trade is much like old school television. It's not on Netflix. Economists and market watchers can speculate, sure. Politicians can make promises, of course. But the bottom line is no one really knows how all this is going to play out. It's yet another element of uncertainty in our already unprecedented age of economic uncertainty. But even though we can't know what's going to happen for sure, we can consider some of the possible scenarios. And I believe we need to consider the possibilities. Why? Because as we've already seen, the issue has the potential to impact virtually every aspect of the economy and the global financial markets. Investors who are retired or within 10 years of retirement should be discussing these potential impacts with their financial advisor right now. and what they could mean for their savings and investment strategies. We'll talk more about that specifically in our next segment. But right now, let's discuss some of the impacts most likely to be felt by consumers and by investors in the near future, according to some experts. We already mentioned the potential for more job losses in various sectors of the economy, but another big concern is inflation. While free trade generally increases purchasing power, tariffs can reduce it. And although Commerce Secretary Wilbur Ross has said price increases will go unnoticed, others believe the impact on consumers will be more significant. Why? Because the tariffs are starting to hit a place of basic necessity that people need to run their businesses or to just survive. Following the last round of tariffs in September, the Office of the U.S. Trade Representative issued a list of Chinese products that are being targeted. Based on that list, some of the goods that might become more expensive for American consumers as a result of the tariffs include televisions, washing machines, solar panels, cars, beer, cosmetics, electronics, certain foods, and clothing. Companies such as Walmart, Target, Gap, Coca-Cola, Macy's, Apple, General Motors have already said that tariffs could cause them to raise prices on their products. In the meantime, in late September, China announced it could cut import tariffs on numerous non-American goods. This move is most likely designed to protect Chinese consumers against the effects of inflation there, while also creating an incentive for consumers to stop buying our United States goods. By cutting tariff levels on non-U.S. goods while increasing them on American imports, China is effectively steering its consumers away from American-made items, which is something that could hurt the U.S. even more. In addition to inflation, we've already seen what kind of effect all the uncertainty around trade war can have on the stock market. We saw it first in the spring when worries over the Boeing dispute helped fuel record levels of market volatility, and again just over the last couple of weeks when the Dow took a 1,200-point plunge over 2 days, largely due to trade war concerns. Meanwhile, China's stock market's taking an even harder hit. While the S&P 500 is still within 8% of its record high, China's Shanghai Composite is down nearly 28% from its all-time high and is the third worst performing global index by that metric. The worst is also China's, a Shenzhen A share index. At its peak, China's market cap was more than $10 trillion, but as of September 12th, it had fallen to nearly half, at $5.73 trillion, based largely on investor worries over the growing trade dispute. Now, is that an indication that the U.S. might have the upper hand and that its trade war is ultimately good and winnable, as President Trump famously tweeted? Well, again, this isn't Netflix, so we can't just jump ahead to the next episode to find out. Mathematically, there are scenarios in which one country or the other could, quote, win this dispute. But there's also scenarios in which both sides could lose, giving other countries the opportunity to step up and increase their own global economic power. We can only watch and wait. But as we do, it's probably a good idea to keep in mind that sound advice we all probably first heard from Mom. Hope for the best, but prepare for the worst. We'll talk more about that also in just a bit. Right now, let's welcome back Jim Rogers. So Jim, you know, we talked about the debt as being a concern here in our country. And again, you are preaching to the choir. I may push back with you on the interview, but the reality is I do agree with that. So how about the concern that a lot of people have here in the United States that sometime in the next 10, 20 years that the Chinese might stop buying our debt or might slow down the purchasing of our government bonds? Long term, nobody knows, but what are your thoughts about the next 10, 20 years? Is that a legitimate concern or not really?
Well, David, who cares whether the Chinese do or not? We need a lot of people buying our debt. We need you and me buying our debt. We're the largest debtor nation in the history of the world. We need everybody to buy our debt. You see what happened this week. The debt skyrocketed another gigantic amount. And Mr. Trump has said, his own government says, it's going to be much, much higher in the next 5 or 10 years. We need everybody to buy our debt. But sure, some people are going to stop. You and I may stop. The Germans may stop. The Koreans may stop. I'm not the only person who knows that we have a huge problem developing in the United States. But when people stop, David, you should be very, very worried, whoever they are.
Okay, and that's, I mean, that's obviously true. Of course, I think that's the reason the president this week came out and is pushing back on the Federal Reserve a little bit, saying, wait a minute, wait a minute, wait a minute. We don't have high inflation. You can't keep raising interest rates. Do you agree with that? Do you agree that maybe we shouldn't be raising short-term rates right away, or we're raising them too quickly?
David, never in recorded history have rates been this low. They've been negative in over 40% of the world a couple of years ago. The absurd thing is that rates were pushed this low. They've got to go back to normal, or we're going to have an even more gigantic disaster someday. You can keep kicking the can down the road all you want, but interest rates, this has never happened, David, never have interest rates been this low. They've got to go back to normal, or we're going to be ruined.
That's what helped make the debt bubble even bigger. So now I know a lot of people watching here are going to be skeptics and say, you know, Jim Rogers is a very credible source. But we also know that Jim has business interests in Asia. So is he biased? And I know you're going to say, well, no, the reason I have interests in Asia is because I believe that there's a lot of growth in that economy. Talk to us about that.
Well, that's correct, but I have business interest everywhere. I have business interest in the United States. I own gigantic numbers of US dollars. So I try to put my money where I can make money, don't you? I mean, isn't that the purpose of investing? Yes, I have an interest in China, but I've already told you there are going to be huge problems in China the next time we have a problem, because China too has debt now.
Mm-hmm. So 15 seconds or so. What's the best advice you can give to our income generation members, those of us here in the United States over the age of 50, when it comes to investing their hard-earned dollars?
Watch Newsmax, and if you watch Newsmax, you'll become concerned, you'll become informed, and then you will protect yourself.
Good words of wisdom. I thank you for that. And Jim, once again, it's been my pleasure. Thanks for being on the show.
Thank you, David.
All right, we'll be right back here with more on the Income Generation. Stay with us. I'm David Scranton.
David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model. Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. As you probably noticed, there are 2 kinds of shows that we do here on The Income Generation. One is instructional. We share practical tips and guidelines for things like calculating how much you'll need to save before retirement, or how to take advantage of year-end tax saving strategies. The other type of show, of course, that we do is educational, an analysis of current market trends that you should be aware of. Knowledge is power, after all, and the more you know about what's happening in the financial world, the more power you have to protect your savings and to meet your financial goals. Now, obviously, today's show falls into the latter category rather than the former. And it's likely that we'll continue to revisit this topic. Why? Because it does have the potential to affect so much, and in many ways that we simply cannot predict or control. As to how it affects you and your retirement goals, well, fortunately, that's something you can control. But it requires you to be proactive. The first step is to sit down with a qualified financial advisor and review your portfolio. If you're retired or within 10 years of retirement and haven't yet shifted your focus from portfolio growth to that of retirement income and protection, then perhaps it's time to discuss that with your advisor. Most importantly, make sure that he or she's the right advisor to help you make that shift. That means an advisor who specializes in, as I like to say, the universe of conservative income-generating financial strategies. If his or her idea of conservative strategies is limited to bond mutual funds, then that person's probably not the right advisor for you in the world of income versus growth. Also, if that person tells you that he or she's reluctant to move you into individual bonds for reasons such as that he's concerned about rising interest rates or the so-called bursting of a bond bubble, well then beware. That person's probably not the right advisor to help you in the world of income. And that person probably is an expert more in the world of growth instead. The reality could be that he or she simply lacks the expertise to manage a diversified portfolio of individual bonds and can only offer the option that's easiest for him or her, and that is bond mutual funds, which is really not even close to the same thing as individual bonds and bond-like instruments. Why? Well, as I've explained before, individual bonds and bond-like instruments are uniquely designed for protection and income. They particularly come with two important guarantees that bond funds don't have: income at a fixed rate for the life of the bond, and secondarily, return of principal if you hold the bond to maturity. Essentially, you're investing with a contract that guarantees these two things. Now, could effects from the unfolding trade war impact interest rates and or the future value of individual bonds? Of course it can, and they already have to a certain extent. Amid all the stock market volatility last week, the yield on the 10-year Treasury hit a 7-year high at 3.25% before falling back somewhat. That continues a pattern that I forecast early this year, in which I said long-term rates will continue to rise, but will hit a strong resistance level or glass ceiling somewhere in the low threes. And so far, we've been unable to break out of that range. We'll have to see what the Federal Reserve does to that in the weeks to come. This is actually good news for investors with actively managed bond portfolios, because it means active account managers can take advantage of small fluctuations to upgrade their clients' accounts for higher yields. But even if rates were to spike higher for individual bondholders, in many cases it doesn't matter. Why? Because of those two guarantees I mentioned and having a contract through which you're investing, any loss in value is truly only a paper loss, which will not affect your income. Now it's time to welcome our second guest, Gordon Chang. Gordon Chang is a well-known columnist for the Daily Beast, author and lecturer whose books include The Coming Collapse of China and Nuclear Showdown: North Korea Takes on the World. He frequently shares insights and expertise in the financial media, including CNN, Fox, Fox Biz, CNBC, MSNBC, BBC, Bloomberg, and of course, we're happy to have him back here on Newsmax in the Income Generation. Gordon, welcome back.
Thank you so much.
So, is this really a trade war, as the media likes to call it?
I think it's actually, people call it a trade war, but I think it's more than that in the sense that the tariffs that everyone is complaining about, they're imposed under Section 301 of the Trade Act of 1974. They're meant to be a remedy for the theft of U.S. intellectual property, because each year China steals hundreds of billions of dollars of U.S. innovation. And so these tariffs are meant to stop that. And so you can call it a trade war, and there are a lot of trade complaints we have with China, but this is really a tech war. And in this sense, that's more important.
Okay, now we have to go to commercial break in just a moment, but in 30 seconds we have left, tell our Income Generation members, is it winnable?
Oh, it's certainly winnable. I mean, China's merchandise trade surplus against the U.S. last year was 88.8% of its overall merchandise surplus. That's enormous leverage that the U.S. has over China. We've got the bigger economy, and our economy in reality is growing faster. We got a stable economy. China's not. Their markets are plunging. Ours are going up. This is easily a winnable war.
So essentially, you're saying they have more to lose than we do in this, which is a very valid point. So stay with us, Gordon, please, for our next segment. You stay with us, too. We'll be right back with much more from Gordon Chang here on The Income Generation. Welcome back to The Income Generation. We're here with Gordon Chang. So Gordon, you heard just a few moments ago Jim Rogers say that he thought China had the upper hand in this trade war because their economy is growing faster than ours. But you seem to be taking the opposite stance. You seem to be saying that, we're a bigger economy and they have more to lose. And also one note that that we made is that our stock market seems to be implying that we can weather it better than China compared to China's stock market. Your thoughts on all this?
Yeah, certainly. China's markets are down more than 20% for the year. They wouldn't be plunging if people in China had a lot of confidence. The currency's down about 10%. And by the way, all of these figures for both the markets and the currency would be much worse, except China is supporting stocks. It's supporting the renminbi. Our markets are up for the year. And reality, we're growing faster. We're growing about 4.2, 4.3%. China in reality is growing somewhere in the 3%, maybe even 2% range. And they've got a systemic debt crisis on the horizon. They haven't had their 2008 crisis yet. They're heading toward it. We've already weathered it. So you look at all of the economic fundamentals, we've got the high cards.
Okay. Now it's interesting. I want to go back to what you said before about the intellectual property theft. A lot of viewers would listen to this and say, I know the president has claimed this, a lot of officials have claimed this. What proof do we have, though, that there is intellectual property theft?
Well, there are two studies. One of them is the Commission on the Theft of American Intellectual Property in 2013. That's the Blair-Huntsman report. It was updated in 2017. Also, you have the U.S. Trade Representative's report issued in March of this year. No one actually knows the exact amount, but everyone puts it into the hundreds of billions of dollars. And by the way, so do U.S. companies that are the victims of this theft. So we know that it is substantial. And it's not just plain out theft. It's also the forced taking of U.S. property with rules that violate China's World Trade Organization obligations. So across the board, either by forced taking or by outright theft, we know that China's theft does range somewhere in the hundreds of billions of dollars.
So culturally, we know that China is probably as unlikely to back down from this. So the question becomes, with the 30 seconds or so we have left in the segment, how long will the struggle last? And what's the best advice you give to our income generation members as to how to protect themselves?
Well, this could last decades, or it could last as long as China manages to keep itself together, which might not be too long. This is a long-term struggle. It's existential because if we can't commercialize our innovation, we don't have very much of an economy. So there's not very many ways to protect oneself, except maybe to get into treasuries and wait. But this will be a long-term struggle.
Yeah, and I can't argue with the treasuries because I think, unlike most people who say there's a bond bubble here in the United States, I believe otherwise. So treasuries are still a safe haven. So Gordon, thanks again for being part of the show. We appreciate you being here. I'd like to thank both our guests for joining us for another episode of The Income Generation. I'd also like to thank you, our new and returning viewers. Last week, global financial leaders gathered at the International Monetary Fund meeting in Bali. One night, they were awakened by a 6.4 magnitude earthquake. They were thankful, of course, that it was only minor. But in interviews and speeches the next day, many used it as a metaphor for the tremors that they see rippling through the world's economy right now. Joachim Fels of PIMCO said the quake was, quote, symbolic of the widespread feeling that the ground under the global economy, financial markets, and multilateral trading system has started to shift. More specifically, finance chiefs identified growing trade tensions as the main source of the tremors, and the issue that might just play the biggest role in determining just how bad the upcoming economic earthquake might actually be. Robin Brooks, a chief economist in the Institute of International Finance, put it bluntly, there's really only one discussion that's happening here in earnest, he said, and that is basically the intensity of the trade dispute between the United States and China and how bad that will get, which is exactly why we wanted to revisit this topic on today's show, and why we will continue to revisit it as it unfolds. The potential repercussions for the global economy and for individual investors are just that big. And even though you can't fast forward this drama to see how it's going to end, that doesn't mean that you can't take action. The first thing that you can do is to stay informed and educated, and you're already doing that just by tuning in. Now it's time to reassess your retirement strategy with the help of a financial advisor who specializes in non-stock market income-generating alternatives geared toward income and protection. One who actively manages these strategies, that has strategies that are designed to help you meet your financial goals regardless of market conditions or regardless of such financial earthquakes. Thanks for watching. If you're close to retirement and you really want to know how to protect and maximize your money, it's absolutely essential that you stay informed and up to date, and right here is where you can do it, on the Income Generation. I'm David Scranton. Thanks again for watching. We'll see you next week.
David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model. Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.